You're watching vTalkInsight, market drivers daily for April 30th, 2026. Oil is trading at wartime levels. AI spending is accelerating, and global rate expectations are shifting again. Today matters because the energy shock, tech capex boom, and central bank path are colliding in ways that could reshape cross-asset performance into year-end. The energy shock that had already driven an 8-day rally in Brent has now turned into a full-blown wartime-style spike. Brent has jumped almost 10% in 2 days to around $123, up roughly 17% over 4 days and over 30% in just more than a week, with intraday prints above 126. Equity futures are struggling to keep up with this move. European benchmarks are indicated more than 1% lower, with equity futures deteriorating into the open as investors try to reprice the growth and earnings hit from sharply higher oil. At the core of this move is geopolitics. The Strait of Hormuz has effectively been shut for around 2 months. U.S. naval forces are enforcing a blockade, and Iran is asserting control by charging tolls on Western vessels, with Washington warning that paying those tolls could trigger sanctions. On top of that, markets are weighing the risk of further U.S. military action, including targeted strikes and even discussion of hypersonic deployments. A prolonged closure could force Gulf producers to shut in wells as storage fills, potentially damaging capacity and turning a short-term shock into a structurally tighter supply backdrop. Oil is now trading near levels where demand destruction has historically started, with estimates in the $125 to $130 range per barrel. A projected 1 billion barrel global shortfall is feeding fears that this is not just a price spike but a medium-term constraint. The inflation channel is already visible. In Europe, gasoline and petrol prices are squeezing households, and airlines such as Air France-KLM see fuel costs rising with no quick relief. In the U.S., gasoline above $6 in California is eroding disposable income, while Asian economies are flagged as particularly vulnerable to import disruptions. Equity performance is fragmenting along energy lines. In Europe, energy stocks are outperforming and offering some support to indices like the FTSE 100, but most other sectors are under pressure, especially autos, banks, consumer, and travel names. French banks, such as BNP Paribas and Agricole, are trading heavily after boosting macro provisions and facing questions about the impact of higher energy prices on activity. By contrast, commodity traders and integrated producers like Glencore and Norsk Hydro highlight how diversified supply chains and in-house power can be a relative advantage when fuel is scarce and volatile. There is, however, a powerful counter-narrative that the global system is more resilient to oil shocks than in past crises. The U.S. economy is less energy-intensive, now a net energy exporter, and growth forecasts have only been trimmed from 2.4 to 2.1%. With recession risk still seen as low. History also shows that U.S. equities have often posted gains in the months after Middle East conflicts. Futures curves point to expectations of some normalization in crude, and energy equities themselves have flattened after an earlier surge, implying the market does not see current wartime prices as permanent. The key question from here is duration. If Brent holds near or above the $125 to $130 band for several months, the typical window when demand, earnings, and GDP start to roll over comes into focus, particularly for Europe and parts of Asia. Watch for any diplomatic movement around Hormuz, signals of U.S. escalation or de-escalation, and whether airlines and consumer companies begin guiding more aggressively on fuel costs. Those dynamics will interact directly with the current tech-led growth offset, which brings us to the role of AI and digital capex. AI-related investment remains one of the strongest counterweights to the energy shock in global growth and earnings narratives. Across major tech firms, capital expenditure commitments tied to AI and data centers are now running in the hundreds of billions, with estimates for the largest platforms approaching $750 billion and the broader group exceeding $700 billion this year. This spend is feeding a powerful but narrow tech-led rally. The S&P technology sector is on track for its best month since the early 2000s, even as many traditional cyclicals face much tougher conditions. Markets are drawing a sharp line between AI spending with visible payback and capex that looks more aspirational. Alphabet is on the rewarded side of that divide. Its search business has accelerated to 19% growth. Google Cloud's backlog has doubled with around 60% revenue growth, and new AI consumer services are gaining traction. Alphabet shares are rallying, leading gains among the so-called Magnificent Seven, while AI-driven cloud demand is also supporting Amazon and Microsoft. Down the stack, companies like Caterpillar are benefiting from surging orders for generators and turbines used in power-hungry data centers, and Atlassian is seeing rapid uptake of its Robo-AI platform across Fortune 500 clients. The flip side is visible in names where AI investment is outpacing clear revenue traction. Meta's capital expenditure is rising more than 100% year-on-year and could reach $145 billion, far above its sales growth, while 97% of its revenue still comes from advertising. Investors are pushing back, with the stock under pressure and trading at a discount to the broader index despite robust mid-20s top-line growth. There are also questions about the durability of exceptional semiconductor margins, and some investors prefer hyperscalers over chip makers for the AI trade, especially as supply bottlenecks in memory, processors, optics, and even power are expected to bite harder into 2027 and 2028. In private markets, the enthusiasm is even more pronounced. Anthropic is reportedly seeking fresh funding at valuations ranging from above $90 billion to as high as $900 billion, while its annualized revenue is said to have climbed from $10 to roughly $35 billion, largely from its Claude Code product. Yet regulatory and execution risks are rising. U.S. authorities are scrutinizing advanced models and infrastructure, questioning proposals for Anthropic's Mythos system, and highlighting concerns about compute capacity and cybersecurity. Against that backdrop, attention is turning to Apple's upcoming earnings and product cycle, including a leadership transition that refocuses on hardware and AI as a potential catalyst for how broad or narrow the AI trade remains. The surge in oil is feeding directly into the global rates debate, reinforcing the shift we discussed recently from imminent cuts to a higher-for-longer regime. Central banks are mostly on hold, but market pricing for future moves has turned more hawkish across Europe and, to a lesser extent, the U.S. Global government bond yields sit near multi-year highs. Long-dated treasuries have seen the 30-year yield trade above 5%, while European and UK yields are grinding higher as investors reassess inflation risks and term premia in a world of repeated supply shocks. In the euro area, incoming data are uncomfortable for policymakers. Spain's inflation has moved back above the European Central Bank's 2% target. France is reporting roughly 2.5% inflation alongside zero GDP growth, and surveys show German households expecting around 4% inflation. The ECB is now explicitly focused on scenarios where energy keeps inflation elevated, with internal projections suggesting it could exceed 4% if the shock worsens. Markets have responded by pricing in around 3 ECB hikes and pushing up implied rates by about 20 basis points over the week, even as officials insist on policy flexibility. The Bank of England faces a similar bind. It has held rates, with an 8-1 vote at the last meeting and only about a 10% probability price for an immediate hike, yet traders still anticipate as many as 3 additional hikes by year-end. Some observers see that market path as a potential policy mistake that could tip the UK toward recession, especially as UK and European growth downside risks are viewed as underpriced. Across the Atlantic, the Federal Reserve has also opted for a hawkish hold, but with an unusually high number of dissents centered on forward guidance, as core PCE inflation holds near 3.2% and jobless claims fall to levels last seen in the late 1960s. Policymakers everywhere are grappling with the same dilemma. Hiking into a supply-driven energy shock risks, amplifying the growth hit and aggravating banking and property stresses, yet standing still could allow inflation expectations to drift, particularly in the euro area, where central bank credibility is under scrutiny. The prevailing stance is cautious, data-dependent, and biased toward holding rates steady for longer, rather than rushing either to cut or to deliver a fresh tightening cycle. From market perspective, that keeps the focus squarely on upcoming inflation prints, central bank language around energy shocks, and any renewed signs of credit strain as higher yields filter through to housing, corporate borrowing, and bank funding costs. The picture that emerges today is of an energy shock that is starting to bite, an AI investment cycle that still provides a powerful but selective growth cushion, and a global rate backdrop shifting toward higher for longer with significant regional divergence. Cross-asset performance over the next few months is likely to hinge on how long oil stays at wartime levels, whether AI-driven earnings momentum broadens beyond a narrow tech cohort, and how central banks balance inflation control against fragile growth. This video is for information only and is not investment advice. If you found this video useful, please like and subscribe to vTalkInsight. Alternatively, visit vTalkInsight.com to chat with our specialized AI market assistant and access the latest interactive market insights.